those stories now and understand how the market is trading. We're joined by Sasha Naryshkine, who's director at Vestact. Let's start off with Vodacom, Sasha. It's an interesting set of numbers. They've had to contend with some big drops in pricing, both data and in the, they defined what they had, how they'd cut because of the MTRs. But the share price down 2% today, is that a reflection that maybe shareholders are a bit worried that they're paying out such a big chunk of earnings? 92% of earnings paid out as a dividend.
It's not a surprise because parent shareholder Vodafone indicated that that was what they were moving towards. So the question to ask yourself, if you still own this and you've owned them for a long time, what's your effective return going to be over the next 3 to 4 years? Is it just going to be dividend growth with kind of muted earnings growth? And if earnings growth is somewhere between 6 and 9% higher year on year, your dividend will also increase by that amount. So over a 3-year period, you're probably getting a 20% return without share price appreciation. So I think this is also an interesting one because 3-4 years ago, everyone said, okay, these companies are kind of maxed out in terms of growth. So you've seen strong growth come through from data adoption, even from lower end consumers. And I think we're still moving in that direction. So away from voice and more newer forms of communication. We were talking off air about the adoption of WeChat, WhatsApp. People even chat via direct messenger on Facebook. So again, a move away from kind of what we would call a traditional model to a newer model. And that all is dependent on speeds, broadband speeds, which are improving everywhere, particularly in the urban areas, and smartphone adoption, which is still relatively low. So you could say there's lots of room for growth, but it's a little bit of a cap's going to be put on it by pricing pressures.
I'd be a bit worried about, and we'll talk to Nadim, who's kind of the expert in this field a bit later, but all this cash that's being distributed. Remember, they've done a $7 billion, rand rather, cash deal with Neotel. They've got 10 billion rand plus that they're going to be putting into the infrastructure. Now, those are big numbers, and yet they're still paying out 92% of earnings. You don't want to see Vodacom, the cash cow, become, stressed to pay out dividends in future if they've already set themselves a 6%, because that's what you're getting on the company. You're getting on the stock today just over 6% dividend yield.
5.5 on a tax-adjusted basis. So, yeah, I mean, again, I think it's the age-old story which their kind of developed world counterparts are grappling with as people have moved and adopted more internet services, what it does. But there are many more applications, if you think about it, from banking to simple payments. We know in East Africa, the payment system that's revolutionized payments across the continent. So Africa, to some extent, has missed that fixed line infrastructure story. So we're sitting with a unique situation for many of these companies, MTN and Vodacom, whereby they'll be able to attract a new sort of clientele who'll be streaming videos for the first time. YouTube has got 1 billion plus unique visitors every single month. So there are lots of people across our continent who've probably never watched YouTube and are probably want to watch YouTube. So think of it from an education point of view, payments, there are many different applications around it. And there's no fixed line opposition of any sort.
It does seem as though there's a positive growth story in that sphere, but when it comes to banks, the likes of Able still struggling quite significantly there. Leon Kokonis must be having a headache every day.
Yeah, and I'm interested to see what he's going to say a little bit later. You've got a telephonic interview lined up.
Late this afternoon.
Why shunt through another 2.5 billion? Why? Are you over provisioning now? Is that something? Also, they've lost the head of their ailerons business, the head of their risk business. I think he's kind of struggling, but the share price having gone up a little bit against having gone down a lot in the recent weeks, it's kind of neither here or there, because they've left one question hanging in the air as well, is that do they need more money from their equity shareholders? They've kind of indicated sort of yes, maybe no. And again, nobody wants that sort of uncertainty. So I hope he clarifies.
Is that 5% today a dead cat bounce? Or have we hit the
I
bottom?
mean, there's an enormous amount of short interest built in there too. So you could see knee-jerk reactions. There's also a lot of reputational risk, as we discussed, I think, on Twitter for Coronation and the PIC. But having those big shareholders as a backstop does give you a little bit of confidence too.
Also looking at some food groups, especially let's pick up with famous brands. It's a popular one in many people's portfolios, and it does seem Nigeria and beefing up against Burger King locally.
And there's a good example of how a company can be in startup phase with family type money, but they recognize the point where they relinquish control to proper management team. Not that they're not proper management team, but to someone who's a hired staff or who's probably got different ways of approaching business. So credit must be given to the family, and also I see Santi Botha is now the chairperson. So credit must be given, I think, and it's a good example of how to build an empire, but then also hand over the reins at the right time. I mean, good growth prospects, margin improvement, also in a very stodgy economy. And that's maybe, drawing towards the laziness of us urbanites who like to get fast food, takeout food.
I wonder if that will happen with Wakaberry, huh? Get frozen yogurt delivered to your doorstep.
Well, there is a Debonair's app, interestingly. One of my colleagues orders pizzas using the Debonair's app. Doesn't need to speak to anybody. Can get extra toppings, 40 minutes. There it is, on an app, on a smartphone. There's another application we were talking about earlier.
Exactly.